The stock market has been shattering records again. Home prices sit at all-time highs, and total household net worth in America has climbed to staggering new levels. By every traditional headline number, this economy looks like one of the strongest in modern history. GDP is growing, corporate profits are solid in key sectors, and asset values keep marching higher. But here's the twist that almost nobody wants to talk about. Consumer sentiment is scraping near record lows. It's worse than many remember from past recessions, and it doesn't match the glowing charts at all. People aren't imagining the disconnect. You can see it clearly in the retirement accounts that are supposed to represent the American dream. The average 401k balance has hit new highs, pushing well past previous peaks. Yet, at the same time, a striking number of people are pulling money out early, paying penalties and taxes just to access it right now. Hardship withdrawals are way up from pre-pandemic levels. Many of these withdrawals are going toward avoiding foreclosure or eviction, covering massive medical bills, or paying for education costs that keep rising faster than anyone expected. So, on paper, we're all in this booming economy together. In reality, it feels like millions of Americans are living in a completely different one. How is this even possible? How can the data scream boom while everyday life for so many feels like a constant squeeze? The uncomfortable truth almost nobody says out loud is that both versions are real. The American economy isn't one story, it's multiple stories happening at once, and what it looks like depends entirely on where you stand in it. Rising asset prices don't spread evenly like some gentle rain that falls on everyone. The trillions created when markets climb don't trickle down automatically. They flow into specific accounts held by specific people. If you don't own those assets in meaningful amounts, the record highs are just a headline you see while heading to work or checking your bills. The real question isn't whether the economy is growing. It is for some. The real question is, who actually benefits, and why does it feel so different for everyone else? To understand it, follow the money. There are roughly 134 million households in America. According to Federal Reserve data, the top 1%, about 1.3 million households, own more than half of all stocks. Zoom out to the top 10%, around 13 million households, and they control roughly 87% or more of the stock market. That leaves the bottom 90%, over 120 million households, sharing just 13% of stocks between them. And it gets even more extreme the further down you go. The bottom half of America, about 67 million households, owns only around 1% of the stock market in total. Not 1% each. 1% split among all of them combined. Teachers, nurses, bus drivers, retail workers, and everyone keeping the country running day to day, they're barely in the game. Sure, more people own some stocks now, often through 401ks. About 58% of Americans have some exposure. But owning a little and owning enough for it to matter are two different realities. For the bottom half, median stock holdings hover around very low figures, like $13,000 or so in recent snapshots. For the top 10%, it's hundreds of thousands, creating massive gaps in how gains hit. Take a strong year where the market returns something like 15 to 16%. For the bottom half, that might translate to a paper gain of a couple $1,000s. For the top 10%, it's tens or even hundreds of thousands in the same period. Multiply that across years of gains since 2020, when the market has more than doubled in many stretches, and the wealth concentration becomes obvious. Participation got broader, but the dollars never democratized. The ownership class captures the overwhelming majority of the upside. But let's step away from the big charts and look at ground level, because the story you hear constantly is that the consumer is strong and spending is holding up. On the surface, total spending numbers can look okay. The truth is buried in wallets and bank accounts. Start with income. Average hourly earnings might show nominal gains, say around 3 to 4% year over year. Sounds decent until you subtract inflation, which has often run close or higher in recent periods. Real wages for many have been flat or negative after accounting for the cost of living. Prices overall are up dramatically since 2020. Housing, food, energy, insurance, all of it. Surveys like Gallup's consistently show the top financial problem for families isn't unemployment or wages in isolation. It's the high cost of living and inflation, cited by a huge share of people, near multi-decade highs. Over half of Americans in some polls say their financial situation is worsening. So if things feel this tight for the average person, How is overall consumer spending still powering through? The answer is increasingly clear. It's coming from debt, from borrowing against the future. Look at credit cards. Americans are carrying over $1.25 trillion in credit card debt. Average interest rates sit around 21 to 23%. This isn't luxury spending or points chasing for most. Studies show a large chunk, around a third, of those with balances cite day-to-day expenses as the main reason. Groceries, rent, gas, medical costs. It's survival debt. And it's sticky. Many have been carrying these balances for years now, with the share rising. Then there's the explosion in buy now, pay later options. Over 90 million Americans use them. What started with bigger purchases like furniture or electronics has spread to everyday stuff. A significant portion of users report financing groceries or using it because they can't make ends meet otherwise. You see the memes about splitting a fast food meal into 4 payments. It's funny until you realize how normalized it's become for millions just to get through the week. And the safety net? Personal savings rates have dropped to low levels, around 2.6-4% in recent readings, near historic lows. For the bottom half of households, the savings rate often goes negative. They're spending more than they take in after taxes, month after month. No buffer for emergencies, just digging deeper. This is the divide. The ownership class sees their wealth grow through assets. Everyone else borrows to stay afloat. Economists used to call it a K-shaped recovery, winners up top, losers down below. But the shape today feels more like an E. Imagine a bold letter E, 3 horizontal bars. Now, stretch the top bar way out, the richest 10%, whose wealth is tied to stocks, real estate, and investments that have soared. Home prices up massively since 2020, markets climbing over 100% in key periods. Their net worth has exploded. They hold the majority of wealth and a huge share of income. The bottom bar sits low to the ground, the bottom 50%. Negative or razor-thin savings, survival debt, financing basics. They own almost none of the appreciating assets. They're running to stand still or falling behind. The middle bar, the middle class, is tilted downward, raises eaten by inflation. They're shifting spending to discount stores, feeling the squeeze tighten. Data shows migration from higher-end to warehouse clubs and budget options. They still have some breathing room, but it's thinning fast. Many are slipping toward the bottom. The numbers paint the picture starkly. The top 10% hold the vast majority of net worth, around 68% or more in recent distributions, and a huge slice of income. The middle 40% hold a smaller share. The bottom half is left with a tiny percentage of total wealth, maybe 2 to 3%, split across 67 million households. The gaps aren't static. They're widening as asset inflation rewards owners disproportionately. That's why the news and your personal reality never seem to match. Aggregate wealth, market gains, and GDP lines all go up, signaling a booming economy. But those charts hide who holds what. The stock market hits records while sentiment stays in the gutter because it's the same country, but completely different economic Americas. The top is pulling away. The bottom is borrowing to survive. The middle is feeling the pressure mount. This isn't one economy, it's layered ones stacked on top of each other. And until we acknowledge how uneven the boom really is, the disconnect will keep growing. What do you think? Where do you and your family land in this picture? Drop a comment below. I read them and it's eye-opening to hear real experiences from across the country. Because the data tells one story, but your day-to-day tells the truth.